Shishir said, I wanted to know what is the best way to earn 1% a month on a hypothetical portfolio of 100K. Well, we're not going to go into too much specifics here because there's a lot of other detail that's already available, and we're going to review that right now. But in general, what most investors who are looking to target a consistent, maybe 1.5%, or 0.5% return per month, in those cases, what the strategies they're looking to do are deep in the money covered calls with a high probability of being assigned, or, oh, sorry, folks, the deep out of the money naked put positions as well. Okay, so there we go. All right, so my apologies. Covered call positions. This is one of the reasons why Ernie developed the monthly picks of the day and the weekly picks of the day for the covered call strategy. I keep forgetting that. Let's pause the screen here for a second. Sorry, folks. I always forget that's not there when I go to do a presentation. I'm so sorry for that. So anyway, in the money covered calls, not married to the stock. We had a discussion a few moments ago for Anthony talking about selling an out of the money call, looking for a dividend like income. If the stock reached that price or got close to it, he'd want to roll further out because he doesn't want to be assigned on the position. With an in the money covered call, I don't care about the stock. I want to be assigned. I want that 65, 70, 75% probability of being assigned and earning 0.7, 0.8, 1%, 1.2% every 2 weeks or every month. Doesn't always happen naturally. You're going to have bad markets. The market's going to decline. And what even with an in the money covered call position, even if you have a 7 or 8% downside protection, if the stock falls 10%, you're still down 3%, and you still have to manage the position. Okay, so let me do this real quick. There's one more second, folks. Shifting my account over. Now it makes complete sense why I was seeing different numbers for the closing prices I thought, why the rollout opportunity I was looking for Eileen appeared earlier when I was evaluating it, but didn't appear here because I was looking at closing prices from yesterday on our webinar account, not from live prices today. Okay, let's try that again. Covered call, monthly picks of the day. Fantastic. Now these are very high returns, but these are also slightly more volatile stocks. Why would we be showing slightly more volatile stocks? Well, when you take a look here to see how we develop these results, it goes through a discussion of what Ernie essentially did with maybe 75 to 80 different iterations of monthly covered call trades to find over time and over different market conditions with downturns in this section here and section here and then uptrends and a little downtrend here, which approach gave the best monthly return, which structure as far as stock criteria, option criteria, technicals, and fundamentals. So over the 3 years tested, there were 87 trades. Average return was 3.9%. 5 trades were stopped out at 30%. On average, the loss, 85% winners, 15% losers at 10.7, for an average of 19% return per year. But it's just over, this time frame, 15 to 18 is what he was looking at. There's a large swing up in 18, of course. But this was being compared against those other iterations of out of the money covered calls. Out of the money covered calls just on SPY, in the money covered calls just on SPY or QQQ, on stocks with low volatility, IBM, McDonald's, and so forth, stocks that did have earnings, stocks that did not have earnings between now and expiration, so on and so forth. Am I saying that this is a guarantee that you'll make 1 to 2% per month or 1% per month even, Shishir? No. Am I saying that the covered call picks of the day, weekly or monthly, or the naked put picks of the day, weekly or monthly, average that 1% return in 2022? No, I am not, because the market conditions were incorrect. This leads me to my next train of thought here. And we had this presentation a few months ago, Shishir, before I think you were involved with power options. But We want to search again, and I'm going to search just 3%. 4 months ago, Max had a question very similar to yours. And he essentially is asking, is there a way for an option trader to make 3% per month, assuming they're fully invested, regularly pay attention, and regularly trading the strategy? Well, that is an extremely loaded question, and it's not something that can easily be answered. Because simply, each investor has their own trading goals, and different market conditions are going to require different strategies and different allocations. So in part one here, we showed move with the market, and we showed how the first 6 months of 2022 were in a bearish trend. That was obvious. From January to June, I think it was even to August, we were in a bearish trend is when we did this presentation. And we showed that even if you did reasonable bear call credit spreads, 85% probability, your portfolio still would have been down about 25% with the fluctuations in the market. You did bull put credit spreads with an 85% probability, that part of your portfolio would have been down about 83%, 85% of what you started with in 6 months. But if you moved with the market, following the signals from the market sentiment tool, you were able more to see that type of profit. But because at any given time, and it happened once during the series, even when we were seeing a bullish indication and we were in a bullish section from the market sentiment, someone opened his mouth about what he was going to do with rate hikes in a few days, and the market took a downturn. We were in bull put credit spreads, and the 3 or 4 bull put credit spreads we would have been in, because we didn't get a bearish indication to switch to bear, were down 50%. It took us the next 2 months to make that back. That happened in June, I believe, before the August expiration, but it was made back and gotten back to a profit on the position. So even though I just said that 1% is the common goal and approach and realization of those doing protected in the money covered calls or out of the money naked puts, unless you move with the market, add other protection, do other adjustments, go further in the money or further out of the money, that goal is not going to be achieved. And this came about, this part 2, know the market. Part 1, move with the market, was an illustration that you couldn't just do bearish strategies and necessarily make money, even though you could draw a straight line from January to June and show a market downturn. There were fluctuations, and the fluctuations hurt bear and bull sides as they moved up and down and whipsawed. Even the covered calls I'm talking about that are in the money, even the out of the money naked put positions. You have to move with the market. But you also have to know the market. And this came about because during the first presentation, we asked a poll. And we asked the poll of the attendees, it says, what was your expected return? And if I remember the numbers correctly, I think it was 58% of those that were joining the webinar and attended said that they were looking for 1 to 2% return. I think maybe the total was 65% of 0 to 1% per month or 0 to 2% per month. And when we ran that poll, Max asked a question that originally I didn't think about, and then we based the second presentation off of that. And his question was, why are people settling for 0 to 1% or 0 to 2% per month? And the answer was key, because very small amount of people were expecting or realizing those higher numbers. And I know you're not asking that question. You're asking for the 1%. 60% of those polls roughly said they were targeting or realizing 0 to 2% return per month. Max said, why would they settle for that? And then the answer was, are they settling or are they succeeding? Because only a small amount of the people who answered the poll were looking to make 3 to 4%. 1%, I think, said they were looking to make 8 to 10% per month. 80% per year, I think I had, 85 to 100% per year. 1%, and there's no guarantee they're realizing it. It's just what they're looking for. And we showed how hard it was in adverse markets to make the 3% per month he was targeting. So is 1% per month settling, or is it succeeding? Where am I going with all of this? 60% of the audience said that they were looking to make 0 to 2% return, roughly, with the two combined poll answers, Shishir. And about 62% of the audience said they were trading married puts or covered calls, naked puts, or collars. I think the question was married puts and collars was the highest, and then covered calls to naked puts was the second highest in that poll. You can watch those videos. As I mentioned, go to YouTube, just search for 3%, check out the first one first, and then the second one later on there, and you'll see it. So yeah, even the married put positions, that's what Ernie and I target, and that's what we look to achieve in the Fusion portfolio there. Using the married put approach talked about in the blueprint with the 12 different income methods, we're targeting 1 to 1.5% per month, but with the guaranteed protection in place, so even if we do have a 10% decline, we might only be down 2 or 3%. Whereas in the covered call with a 7% protection, if you have a 10% decline, you might be at a 3% loss. We're about even, but again, further losses than that unexpected, we have a set limit, and we're going to use income to generate against these positions to lower that initial at risk and potentially bulletproof the trade. So, on the married puts, as I mentioned, talked about in the blueprint, even though it's a more bullish structure, we have the protection in place, and that's our targets as well. Oh, and Shishir, I'm not going to have time to go into this because I got to get to David's questions. So it's a good follow-up question, Shishir, but what I'm going to say is that he asks, of course, how would I use the sentiment indicator to guide opening a covered call or an OTM put? Well, when you see a buy indicator, that's usually a good time. Right now, we're at a sell warning, it looks like. I might be hesitant to buy a new covered call or put. And what I mean by that is I'd be hesitant to enter a new aggressive covered call or an aggressive out-of-the-money put. I might do something conservative. Let's just go here, naked put search. And let me just see which ones. I probably wouldn't, I might use the weekly, but everyone has their own preference. But if I look at the weeklies, I want to make sure of one thing right now, especially. No, not doing that one. Okay, but yeah, I want to be not between now and expiration. I still want stocks that are trading in an uptrend. So these positions all have a good naked yield, and that's for 1 week out. But you know what? If I'm seeing that sell warning and I want to keep the strategy, even though these are earnings criteria, I'm adjusting it. Even though I can't guarantee, that the outcome of this, because I'm going to change it, but I see the sell warning, I can only trade covered calls and naked puts in my accounts, I'm going to make some adjustments. I'm going to put my percent to break even up to a minimum of 2%. I'm going to go with my range out of the money, maybe as much as 4%, but I still want to see a 0.5, maybe even just as low as a 0.4%. I tell you what, let me put in at least an 80% probability as well. And I see ones I wouldn't trade right now. Coinbase I would not trade. Tesla jumped in, nope, too volatile. I'm looking for some common names. But yeah, these are all too high of a return. You know what I'm going to do? I'm going to change the sort. I'm going to go by highest probability, which will be the lowest yield. And is that going to reach my goals? Absolutely is. I know it is. But let me just switch it this way. It'll be faster. Okay, JD.com, only a 0.4% yield, but that's for 7 days. So if you get 0.4 4 times, that's around your wheelhouse, isn't it? That's what you're looking for. Or maybe even during 2 weeks. Skyworks, I'm looking for things that are a little bit more stable. Hess. But again, I know I'm trying to avoid earnings between now and expiration. There's Anet. It's been on a good run, but it's also very fickle. The market can be fickle. And that's the case. But to answer your question directly, similar topics are available. And I think even if you go to the market sentiment tool, that's why we have these help videos here. So this one's talking about the market sentiment tool. It's a little bit older, but we have dozens of videos, similar questions that have been asked. I actually need to do this, and I will do this. I'm going to have a playlist on just the market sentiment tool. This was from last week. Are there specific strategies using the market sentiment tool? It's a review of how we do that. Current look, clarification on the market sentiment tool. This was a fun one from 3 months ago. We started seeing a strong buy near the end of December, and one of our older customers that was coming back, curious to restate his subscription, said, well, I just restarted a trial, and you're showing a very bullish buy. You expect me to buy in this market? And then the next 7 days later, on the next Friday discussion, the market was up. And then the market continued, and then the market pulled back. Okay, how do you use the market sentiment reading indicator if you looked at using this for a basis for trading? Okay, so there's answers that we show there. And typically, Shishir, what we're doing is it's not so much Ernie and I do react immediately, or we react when we start seeing bullish buys or sell warnings on the market sentiment tool. But it's not that I'm sitting there on cash waiting for the market sentiment to give me a signal. I'll be between signals. I'll be in bullish strategies right now. I see the sell warning. Okay. I'm looking at it as to what adjustments I might make, knowing that's in play. I start to see the strong bearish sells. You'll see this in these other webinars. I'm going to be forced probably to take more action at that time to protect the positions. I'm not switching from bull to bear necessarily. I'm protecting or lightening up the bullish positions I already have when I start to see a signal change. And then when that signal change goes into the strong bearish, then maybe I'm going to open some other smaller bearish positions to try to take advantage of that. But my focus has to be on closing existing bullish positions for a profit, protecting or overprotecting existing bullish positions that I have time invested in and a lot of money invested in, or lightening up on leverage bullish positions I have in my portfolio. So if that downturn does occur, I'm not losing 50% on the 3 or 4 trades I've allocated for bull put credit spreads or things of that nature. Okay, so it's not that we're just sitting on most of our capital waiting for a signal to go. We could probably profit on it in that way. We're in our positions following what we wanted to see in those cases, meaning that the last bullish indicator, I was opening bullish positions. Ernie's now slightly near full investment of his portion of the portfolio that he allocates for married puts. He's got 6 or 7 open right now, I think, in the Fusion subscription in those cases. So that's where we kind of stand right now. So that's just what I'm looking at, but you'll see more of that here, some of these better videos. Clarification on that, look at the market sentiment tool, managing positions using the market sentiment tool. So we've had a variety of different presentations in the last year, last 2 years, last 3 years, especially imagine in 2020 when we saw a lot of different market sentiments go off during that time period. And we had different webinars explaining what was going on and how to analyze that also. So, but mostly it's used for the management because we're not just sitting on capital, as I mentioned, waiting for a signal. We're in our positions from the last signal where we felt the market conditions were. Now we see a change, not necessarily the sell warning change, but when it starts going to a bearish sell, deeper red or very bearish sell, then I might start taking action, as I mentioned, to lighten up on the leverage bullish positions, close out profitable bullish positions if I've hit my target, adding protection or extra protection to the bullish positions, and then maybe taking a portion of my portfolio that I lightened up with, or that I did have a small amount aside, to look at some bearish positions for a quick play. Nothing major. I'm not shifting my whole portfolio from bullish to bearish or from bearish to bullish at that time. Now, let's get to Dave. Dave's been patient, asked several questions. David, I should say, the live ones. Dave says, how do you use the long option finder, and can you use it against current positions you may have? Well, yes and no, but the long option finder can be found under the signature tools or just under long call and long put. And what this tool does, David, is essentially just show you which option to buy, which buy option would give you the best return based on your expectations for an underlying security and your target. What do I mean by that? Well, we've had some questions that have come in about AZN. Scott mentioned he was bearish on AZN, and he had, what does that mean? It means he has an expectation that he thinks the stock is going to decline in price. Right? He's seeing a decline here. It's already moved down from 71 to 65.50, and he's seeing a downward trend. He thinks it might continue, let's say down to 60. He wanted to know the time frame. I don't really have a good gauge for him, but let's say it falls down to $60 or $61 in the next 2 to 3 weeks, and I'm going to put $800 into options. Okay? And I said 2 weeks, right? So we know the earnings is the 9th. So let's say even before the earnings, that by 2/8, I know that's only 12, 15 days away, not as much as I said, but I expect it to drop down before the earnings to about $61. It's based on my research, okay? It's based on my intuition, what I think is going to happen. What did this tool just do? It went out and looked at the entire universe and the entire available options for AstraZeneca. It knows the current price, and it knows how many contracts I could buy based on the input I gave for my investment amount. And I could buy 7 contracts here of the February 64. What this tool did in that instant, David, is it calculated what each of these options would be worth if the stock hit my expected target price on or near my expected target date, and which option would give me the best theoretical return based on the Black-Scholes pricing model. Okay, that's all it's doing. So with your follow-up question, can you use it against current positions you may have? Well, sure. All you're saying is, hey, if I've got a stock position, I want to enhance returns, and I actually am in AstraZeneca, and I think it's going to recover back and go up to $69 per share in that same next period before the earnings come out. What call options now would give me the best return? You're not going to see puts here because they wouldn't be profitable if the stock moved up. Just like we didn't see calls in the first bout when we put a stock value below the current price because they wouldn't be profitable. Only the puts would be profitable in a downturn, and so on. So that's what this tool is designed to do. It's just to help to show you quickly, rather than looking at the option chain or then taking each option and going to the Black-Scholes pricing model to evaluate what would each option be worth if the stock hit your price and your date. This is doing that work for you. You're thinking about buying a call on a stock or put on a stock. Why? It's because you have an expectation that the stock's going to be moving up or moving down. And you have a target. You might have said, hey, I like this downturn, just as Scott said with AZN, and I think it might continue this downtrend. And maybe that's why Scott was asking me the question, because he wanted to say, hey, I want to know a little bit more of what decline I might expect and what time frame, so then the long option finder tool could show me a better gauge of what to actually expect and what option I should target. But again, it's all based on, you knew you were going to buy puts on this, you're expecting a downward trend, but hey, let's take a look at it and say, if I expected that downward trend to continue, and I expect the stock to be at $61 or $62 in the next 2 to 3 weeks, I want to put 800 into options. Which option is going to give me the best return if the stock hits at or near my expected price on my expected date?